Yeah, guys. So sorry. Okay, cool. So, guys, welcome you all to FX Grades. This is Carl speaking. As you all know me, I'm here to further elaborate on the video that I did, and also the homework, because I think some of you did not understand what actually I was trying to implement or trying to say to you. So the first video was about like introducing you to liquidity, like where does our liquidity lies at? Okay. Okay. So the first thing that you need to understand and that you need to know is that each and every week, like when like the weekend, we have to go to your charts, like go there. When you go there, you'll be like, okay, guy, where is the next weekly candlestick likely to draw to? Is it likely to expand higher? Sorry. Is it likely to expand higher or is it likely to expand lower? Okay. You don't know me, but according to what you have or according to what you know. So here's the thing that I'm going to introduce now. Liquidity lies between where? Between old highs and old lows. Don't mind that thing of like the liquidity lies between the trend lines. No, liquidity lies between the old lows and the old highs. Why? Because people from here, they are what? They're expecting what? They're expecting an order block there. They're having an order block there. And some they're having support, and some they're having resistance, and some they're having trend lines. So smart money is likely to do business. Like it's not likely. Smart money is going to do business from those lows and from those highs by doing what? By taking out the liquidity out of the market. You feel me? By taking out liquidity out of the market. And the market is likely to draw down to the old lows and to the old highs to take out liquidity, or is likely to draw down to what? To an imbalance to go and fill in the price. You feel me? Or an FVG, we call it a fair value gap. It's more likely to draw back to the fair value gap to rebalance the price between buyers and sellers, because the price must be balanced. The buyers, they must have their time. The sellers, they must have their time. So each and every time the price must be balanced. And remember, we do not move in a straight line. The market moves like in a zigzag motion. So they buy, they sell, they buy, they sell, they buy, they sell. You feel me? So that's why the market went down to do what? To fill in the imbalance. What is an imbalance? This is an imbalance. As you can see, no other candlestick came down to do what? To fill in the gap. So the market came back to do what? To fill in that gap, and then it went up before it came down. You feel me? So the market now, to me, when the market was still here, I was here actually, but through backtesting and learning, I saw this thing. When the market was here, to me, I would say the market is likely to go where? To go down and take out liquidity from this low. Because a lot of order blocks, a lot of buy stops or sell stops or buy limits or sell limits, they are lying from here to take them out, and then it can come here, continue with the order flow to the downside, or it can come here and then we continue to the order flow to what? To the upside. You don't know. But to me, it was like the market is likely to come and take out liquidity from where? From this low. Okay, cool. So let me tell you something new. Again, liquidity lies between short-term highs and short-term lows. That's where liquidity is, and the market is more likely to draw down or to draw up to take out liquidity from where? From those short-term highs and short-term lows, or to come back and fill in the price. You feel me? I hope I'm explaining it properly. Okay. Okay, let me just take something to draw. Okay, let me take the brush. You see here, this is an old high. There are what there are buy stops, because after this break, people they'll be waiting to what to go higher, and then some of them they'll be waiting to go where to go down. So those people, all of them, they're gonna be taken out. The first one, of course, like are those people that are willing to sell. They are going to sell, they get taken out. First people, and then others will say, okay, it's a breakout, retest, they get taken out because the market is going to come back or then continue with order flow. You feel me? So between old highs, there is what? There is liquidity. Between old highs, or we can call them short-term highs, there are buy stops. So there is liquidity. You don't look for an order block there. Here, there is liquidity. Here, there is liquidity. Don't look for an entry there. Unless there is a what? There is a fair value gap. I'm still going to talk about them. Even check here, this low. Didn't you break the structure here? Yeah, you did. Why did this low not hold the price? Why? Because here there was a lot of what? Of order blocks here. A lot of people, they were waiting for what? They were waiting for an order block. Some they were having support, some they were having resistance or trend lines, and then they got taken out. Another example, didn't you break structure here? Yes, you did. Why did the market not react from this order block? Why did not hold the price? Because there is what? There is liquidity. Short-term highs and short-term lows, they hold liquidity. That's the only thing that you should focus on, not on the like on the trend line liquidity, the liquidity that they talk about. That's not it. The only thing that the market is likely to draw to, the market is likely to draw to where? To the short-term highs to take down liquidity, because there's what the buy stops, or to draw down to take what? Short-term lows, because there's what they because there is liquidity, like there's sell stops, or is more likely to come down and fill one and fill in the imbalance so that the price can be balanced between the buyers and the sellers. Okay, hope you understand me. Okay, let me go down to 1 hour. I was just using that replay thing like to show you what was happening that time. Okay. Okay. So here, this was the first week. This was the week of in January. It was 21st week. No, it was not the 21st week. It was on the 21st of January. Like it was a new week. A new week. It was the last week before the end of January. If you okay. What is the other one? Okay, I'm sorry guys. I'm sorry. Let me add. Yeah, I think it is. So the market opened Monday on the 17th of January, and then the market closed where on the 21st of January. No, it was not the last week, okay, but it was one of those weeks around January. And then on Friday, check what happened on Friday. Liquidity lies between old highs and old lows, and also previous daily highs and also previous daily lows. I hope you are listening to what I'm saying. Liquidity lies between old weekly highs, old weekly lows, old weekly, no, daily lows, and old daily highs, and also the session highs and lows. We have the Asian session, the New York session, and the London session. The Asian session starts at 2 a.m. in the morning South African time. That's what I know. 2 a.m. and then it ends at 8 o'clock in the morning. And then the London session starts at 9 o'clock in the morning, ends at 1 o'clock, 1 o'clock, at 1. And then at 2 o'clock, the New York session starts and then ends at 6. Those are the kill zones. Those are the kill zones. Okay, but we're still gonna go further to them. Okay, so let me show you what happened here. Okay, cool. You cool? You cool? You cool? That's fine. And then, okay, on Friday, this is the previous daily high. There is what? There is what? There is liquidity. There is buy side liquidity from there, because some people, they will be waiting for what? For a double top to sell, of which they will not get it. They can get something like this and then they get taken out. And then after get taken out, like if you've been through those retail things from YouTube, after this break of a high, you put what? You put a buy stop. Then people, they will be buying, thinking the market broke out. Some, they will be like, it's a breakout and retest, and then they will be buying. They're not going to get that. The market instead will just give them something like take them out, and then continue with the order flow like this. Feel me? Okay. So between old monthly highs and monthly lows, weekly highs, weekly lows, previous daily highs, previous daily lows, and also session highs, the New York session high, New York session low, Asian session low, Asian session high, London session high, London low. There is what? There is liquidity there. There are sell stops and buy stops. Okay. For an example, you see liquidity was taken from where? From here. Why it was taken? Because that was what? That was a previous daily low. So a previous daily low contains what? Contains liquidity. And also a previous daily high contains what? Contains liquidity. Okay, I'm introducing you to liquidity. Actually, I'm not introducing you to liquidity, but I'm telling you that the liquidity that you must be focused on, the liquidity that the banks, like not the banks, that smart money not smart money concepts, guys. I'm not on trading smart money. And the only liquidity that they focus on is between the highs from monthly, daily, session highs and lows, and those daily things, monthly, weekly, session lows and everything. There is what? There is liquidity. Don't look for what? Don't look for buys from there, and also don't look for sells. There is what? There is danger in those areas. The market is more likely to do what? To draw down and take what? And take out liquidity. You feel me? And take out liquidity from where? From the previous day highs, previous day lows, monthly highs, monthly lows, weekly highs and weekly lows, and also session highs and lows. So to me, as I told you, this is it. Okay, let me go back. This was the low. The market was here. So the market was more likely to draw where? To draw to the downside, to do what? To take out this low. Why this low? Because this low contains what? Contains liquidity. It was a previous weekly low. It was a weekly low or something. It was a weekly low, or it was a yearly low. But this is what? This is a clear low. It's an old low. So people, they were expecting what? They were expecting buys, because they had what? They broke the structure. So they're waiting for an order block, and then they buy from there. Show me. Yeah, this is it, guys. This is it. Don't be scared. Don't be scared. What's up with the network, man? Don't be scared, don't be scared, don't be scared, don't be scared. This is it. This thing happened when it happened Friday. So this is the previous daily high of Friday. That was the previous daily low of Thursday. So this is the previous daily high of what? Of Friday. And then this is the previous daily low of what? Of Friday, which it was taken out. Okay, let me mark it. Let me mark it too. This is the previous daily low of what? Of Friday. And then it got what? It got taken out. Okay, cool. Okay, let me also mark in the sessions for you. At 2 o'clock, you get what? The New York session starts. The New York session has its work, but I'm not going to speak about it now. It has its work that it does. Okay. And then the New York City, the London session starts where it starts at 9 o'clock and then ends at what? At 1 o'clock. Okay. I'm marking it up for you guys so that you can see what the fuck. Okay, let me change the color. Just need this one. And then the New York session starts at 2 o'clock and then it ends at 6 o'clock. South African time. This is South African time. Let me use another color. Okay. Listen to me carefully. Please listen to me carefully. Liquidity lies where? Liquidity lies between the session highs and lows, and also the weekly highs and lows, daily highs and lows, and also monthly highs and lows. Okay, so this is the Asian high. Feel me? And then this is what? This is the Asian low. I know it's gonna be tiring. I know it's gonna be tiring. This is the what? This is the London high. You're feeling the heat. This is the London low. Okay. This is the New York session high. This is the New York session low. Get me? Okay, let me get rid of some. Let me get rid of these things. But I didn't want it to be like this. Hey, this thing of Zoom. Yo. Man. It's in New York. What I'm doing now. New York. High. New York session. No. Hey, which one is this one? No, this is the previous daily low. Okay. Ish, guys. This is the London This is the London session low. And why? Left, top, left. Oh, I wonder which one is it. No. See, I'm making a mistake. It's an Asian low, this one. This is an Asian high. Okay. This was the London low. She's taking time now. Oh, sleep a lot in the bottom. Then go left. What the fuck? This is the London high. Yeah, bottom go left. Yeah, go on top, man. Okay, let me just mark them, okay, so that you can see them properly. You want to add more colors, man. Is this thing is going to be colorful? Yeah. About the colors, guys, hey, you can put your own colors. Don't use mine. You can use your own colors. You can even use your own thing, your own chart thing. Yeah, don't use mine. You can use your own. You can use your own. I just use any random color that I want to use. So don't be like, there's a specific color that you have to use. Nah, there's no specific color that you have to use. Okay. So as you can see, now that day closed, né? This is the previous daily low of this day. This is the previous daily high of what? Of this day. And then the market comes into where? It comes into where? To Friday. So you know between previous daily highs and previous daily lows, there's what? There is sell stops and buy stops, which means liquidity. Okay. So the market opens up. After opening up, it opens with the Asian session. The Asian session opens up, and then it does what? It takes out this thing. It takes out the previous daily low. People, because here they are having what? They're having what? An order block. No, not even an order block. They're having it's a resistance. No, they're having support, and then they get taken out. As you can see, they get taken out completely. Okay. And then the market rallies higher. It comes back and creates what? It creates an Asian low. And then after creating this Asian low, it rallies up to take what? It takes that Asian high. As you can see, the Asian high, that was the high. It started around 2 and then it ended at 8 o'clock. When it was 8, this was the candlestick at 8. And then it went up to take what? To take out liquidity from the Asian high. And then after taking that liquidity from the Asian high, the London session started. It was the London session that sponsored the move that took out the high of the Asian session. You feel me? And then after taking out that high, the market went up to create what? To create a London high. And then the London high, it went down. You see? That's when 1 o'clock ended. 1 o'clock, it created the high and the low. And then at 1 o'clock, the London session stopped. And then after the London session stopped, the New York session started what? It started at 2 o'clock. And then after starting at 2 o'clock, it sponsored the move that took out what? It took out the London low. because people from here, they were having what? They're having support. As you can see, we gave them that buy, and then after giving them that buy, the market went down to take them out. Okay, after taking them out, the London session sponsored the move. Which move? It sponsored the move that both took out the Asian low. It sponsored the move that took out the London low first, and also the move that sponsored the Asian low to be taken. As you can see, it was taken. And then after the Asian low was taken, it went up to do what? To take out the London high. As you can see from the London high, we're having what? We're having equal highs, but I'm still going to go to it. And then it created the New York low, and then it created what? The New York high. So between these two, one must be done what? One must be taken out. You feel me? So now I'm just explaining the liquidity. That liquidity lies between old highs of the weekly, like old highs and lows of the weekly, monthly, daily, the session highs. I'm explaining them to you now. I hope you understand me. Since my trading view is not paid, so I'm not gonna go. I'm not gonna be able to go to a smaller time frame, but there is a screenshot that I took on 30 minutes. Okay, let me pause the video. Let me pause the recording. Okay, good. So let's go to paint. Okay, okay, let me open. Let me just put it down here because yeah, I can't even hide it. Is there any way you can hide this thing of the zoom thing? But you can't see it, guys. So you can't. Okay. So this is the 30-minute time frame. So from this 30-minute time frame, what is this? What is happening here? This was the previous daily low, and it was taken out. And then at 2 o'clock, this is 2 o'clock, this is 2 o'clock. The new, the Asian session started. This is the Asian high, and then this is what? This is the Asian low. Okay. And then the market rallied up to take what? To take out the Asian high. After taking out the Asian high, it was the London session that sponsored that move. As you can see, this big candle, it opened at 9 o'clock and then it took it out. And then it created what? It created a London high. This was the London high. Okay, that was the London high. And then this was the London low. And then at 1 o'clock, this is 1 o'clock. At 1 o'clock, the New York session opened. And then after the New York session opened, it sponsored the move that took what? That took out the London low. As you can see, the London low was taken. And also the Asian low, it was taken. You feel me? And then after all of them, they were taken out, it went up to take what? To take out the London high. And then it reacted from an imbalance. Okay. So I wanted to show you this thing from here. Okay, cool. Let's take the new one. No, don't save, man. Who are you saving for? I saved them like these. See, now this one is more anointed and like it is like it is more thing. Okay, guys. So what is this? This is sell side liquidity. Why is it called sell side liquidity? Because they are what? They are sell stops. Why they are sell stops? Because this is the Asian low. So the session highs and lows, they contain what? They contain liquidity. Okay. And then this is buy side liquidity because that is an Asian, no, that is a London high. And also we're having what from here? We're having support. See how nice is this thing? they're gonna say this is support. You feel me? Because they're gonna have 1, 2, 3, third touch. So to them, they're having what? They're having support. Oh. So from there, they're having what? The retail traders, they're having what? They are having their support and resistance, of which that is liquidity, which is buy side liquidity. Because after this break, they were doing what? They were buying. You feel me? They were buying, and then the market did not let them buy. The market is more likely to draw, to go and fill in the imbalance or the fair value gap, or is more likely to go down to the session highs and lows, and also the daily, like the lows and the highs of the daily, weekly, and monthly, to take out liquidity. Okay, so check what you are supposed to do. This is liquidity. This is liquidity. Okay, why? Because that is an Asian high, and then this was an Asian low. So there is what is liquidity, and then it was taken. Where was the market likely to draw to? The market was likely to draw to an imbalance to fill in the price. What is this? This is the fair value gap. That was supposed to be your what? That was supposed to be your first entry of the day, because the market came back to fill in that fair value gap. And then after filling in the fair value gap, it went down. So that was supposed to be your what? To be your first entry. Okay. First entry, because the market came back to fill what? To fill in this imbalance. To fill in what? To fill in this imbalance. And then after the imbalance was filled, the market went where? It went to the downside. And then after going to the downside, what did the market do? The market went up, and then it came back to give them what? To give them their second touch. And then it went down to take what? To take out the Asian low. And then after taking the Asian low, the market rallied up to do what? Okay. Okay, so now as you can see, this one is more. Okay, no. Let me use this one first. Let me use this one. 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 This is one. This is a fair value gap. That was a gap. Don't like mind that shit. Like guys, me, I have my own trading rules. You're gonna have your own trading rules. I'm not gonna teach you. I'm not gonna let you. Like I'm not gonna lie to you and say you can use my own trading rules. That was the fair value gap. So mine, I take the entries when the market comes back to the 50% level of the fair value gap. But if to you, you don't like that thing, because sometimes I miss out on trade because the market does not usually go to the 50% level. So I miss out. So if you don't want to miss out, you can take the entry when the market hits down the fair value gap, and then you take that entry. You see, if you took it from here, you would have got a sniper. But to me, I would have missed the entry. So I'm not gonna teach you your like the rules. You're gonna make your own trading rules. You feel me? Okay. And then the market that did what? It came back. Okay. Let me show what I wanted to show. No, don't say it, my guy. Who are you saying? Oh, you want to understand. So this is the buy side liquidity, because retail traders, they're having what? They're having resistance from here. This is first touch, second touch, and then third touch. And then the market does what? The market takes them out. And then the market reacts from that imbalance that I showed you there. That it's not visible from here. But it reacted to the imbalance, and then it went where it went down. It went where it went down. It reacted from the imbalance. I think the imbalance was there. The imbalance was there. About your stop loss, you're gonna put your own stop loss when you trading according to what the market is giving you. If you are trading 1% per trade, you're gonna put your stop loss to be on 1%. Like your loss is gonna be 1%. If you're having 100 rand, you're gonna lose 10 rands. If you're having 1,000 rand, you're gonna lose 100 rands. You feel me? According to what you wanna lose. So at first, we took out this liquidity, this buy side liquidity. You feel me? Check why I am saying this is buy side liquidity. After these people, they were taken out. They were waiting for what? They were waiting for a retest. From here, this is their retest. This is their retest. As you can see, and we gave them that buy, and then they bought, and then they got taken out. You feel me? And I still want to talk about this entry, but I feel like not talking about it now. But now, like I think I've spoken enough about the liquidity, because I still want to teach you about the only shift or the break in market structure that matters in smart money. After you break the structure, the market must come back to where? To the FVG. This thing happens every day, but I'm still going to talk about it. Even here, you broke what? You broke the structure, the market came back to the FVG, you get a sniper. This is 2 minutes chart. You feel me? But I think guys, I love trading, man. I love trading. I love trading a lot. I love trading a lot. Okay. So this is what I wanted to explain. Listen to me again. Liquidity lies between the highs and the lows of the weekly, daily, monthly, and the session highs and lows only. Don't mind the other shit that they took out from someone and then they made it look like it's theirs, you know, because smart money concepts, it's what they stole from ICT. That's not their thing. ICT founded all of those things. Okay, so now we are learning the real shit. So I'm still gonna talk about this shift in market structure. It happens each and every day, but today this is what I wanted to talk to you about. This is what I wanted you to understand about liquidity, where our liquidity lies, and where the market is more likely to draw to, and how to react to it. Okay, we're not having order blocks here. The only thing that we are looking for liquidity. In order for you to take an entry, there must be someone who must be taken out. Remember that shit out. That we have to spot the liquidity. If you don't spot it, we are liquidity. So liquidity must be taken first before you sell. Where is your liquidity lying to? Like the liquidity lies between the lows and highs of the weekly, monthly, daily, and the session highs. And the market is more likely to come down or to go up to fill in the price, like by making sure that the price is fairly distributed between the buyers and the sellers. And then we're going to look for that fair value gap. And then from that fair value gap, we take an entry, we sell or we buy. And I'm still going to talk, as I said, I'm still going to talk about this entry. If you can miss this sniper, you can get this one. So guys, it's kind of great signing out. I love you all, guys. I love you all, guys. Let's work, man. This thing is easy. Just use me. Okay, I'm here for you guys. I don't sleep. You can check the time now. It's 4:30. Maybe you are in deep sleep, but Kyle is not sleeping. So yeah, guys, let's just work on this thing and let's push it together. Let's push it together. And then after pushing it together, we're gonna be good. 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 You feel me? Because the aim is for everyone to get financial freedom. The aim is not for me to get financial freedom, but the aim is to help everyone. That's my goal, is to help everyone unlock financial freedom. Because there's more than 6 trillion that is out there on the market. So I cannot be greedy and say that money is mine alone. That money is not mine alone. And I want you guys to be your own signal generator. I want you to create your own signals. What do I mean when I'm saying for you to create your own signals? Like for you to be able to trade on your own. The only thing that I preach on my mouth is independency. Nothing more, nothing less. Check even here. It is the break. This is the imbalance. This is the fair value gap. The market fills it in. It rallies up. If you can go to 1 minute, you can find that gap, that break of structure from there. This is the fair value gap. The market fills it in. It goes down. This is the fair value gap. The market fills it in. It goes up. It happens each and every day. Each and every day. So yeah, guys, I hope you all good. I'm good on my side. Had great signing out.